Imagine this: you've spent your entire life saving, planning, and building a future together. You and your spouse carefully budget, invest wisely, and think that when the time comes, everything will be okay. But then reality hits. When one spouse passes away, the surviving partner not only faces emotional devastation, but also an unexpected financial burden that most people don't even see coming. It's called the widow's tax penalty. And if you don't plan for it, it can strip away thousands of dollars every year, money you thought was safe. Let's break this down. While both spouses are alive, you usually enjoy the tax benefits of married filing jointly. That means higher income thresholds before hitting higher tax brackets, better deductions, and more flexibility. But the moment one spouse passes away, the survivor loses that benefit. Now they're forced into the single filer category. And here's the catch: even though their income has dropped, their tax rate often increases. Take Social Security benefits as an example. A married couple might have two streams of Social Security income. When one spouse dies, one of those checks disappears, but the tax burden doesn't vanish with it. In fact, the surviving spouse may pay more on the remaining benefit because of the new filing status. Now let's add retirement accounts to the mix. Those required minimum distributions, or RMDs, can hit hard. When both spouses are alive, RMDs are often spread across two people, lowering the impact. But when one spouse passes away, the entire retirement account balance falls on the shoulders of the survivor. That means larger distributions, more taxable income, and higher tax brackets, right at the time when income security matters most. So what can you do about it? That's where proactive planning comes in. First, consider Roth conversions while both spouses are alive. By moving traditional retirement account balances into Roth IRAs, you reduce the tax burden for the survivor because Roth withdrawals are tax-free. Next, think about trusts or life insurance policies designed specifically to offset this penalty. Life insurance proceeds are often tax-free and can be a lifeline when taxes increase unexpectedly. Another critical step: take advantage of the widow's window. In the year of a spouse's passing, the surviving partner may still be able to file jointly. Which can be the perfect time to make strategic moves, like Roth conversions or harvesting gains, before the filing status officially changes. And finally, the most important piece is conversation. Too many couples avoid discussing these topics because they feel uncomfortable or even morbid. But planning today means peace of mind tomorrow. If you wait until tragedy strikes, it's too late. The IRS doesn't care about your grief. It cares about your tax return. The widow's tax penalty is real, it's painful, and it's avoidable with the right planning. Every spouse needs to look beyond the present and prepare for a future where one of you may be left behind. And everything makes a good investment, because true financial security isn't just about growing wealth. It's about protecting it when life throws the hardest curveballs. The widow's tax penalty is one of those financial realities that most couples never think about until it is too late. Yet it can completely alter the financial picture of the surviving spouse. When people hear the term penalty, they assume it is some extra fee the government charges, but that is not quite the case. Instead, it is a shift in how taxes are calculated after one spouse passes away, and the impact of that shift can be brutal. While a couple is alive, they are able to file their taxes under the category of married filing jointly. This filing status comes with significant tax advantages because the IRS essentially gives you double the standard deduction, wider income brackets before moving into higher tax rates, and more flexibility when it comes to things like capital gains and deductions. That system works as long as both partners are alive, but once one spouse dies, the survivor is forced into the single filer category, which is much less forgiving. Imagine a couple that together earns a modest retirement income of $80,000. Filing jointly, that income would be spread across tax brackets designed for two people. So they might only pay around 12-15% on a good portion of it. But when one spouse dies, the surviving spouse does not lose all of that income. Maybe they keep most of it through Social Security, pensions, or retirement withdrawals. But now, instead of the higher joint filing thresholds, they are taxed under the single filer system, which pushes them into a higher bracket much faster. The result is that even though their income may have dropped slightly, their taxes actually go up. That is the penalty. It gets even worse when you factor in Social Security. A married couple often has two social security checks coming in. When one spouse passes away, the survivor keeps the higher of the two checks, but the smaller one goes away. So let's say a couple was receiving $2,000 and $500 a month. Together, that was $3,500. After one spouse dies, the survivor is left with $2,000, which is already a hit to income. But here's the twist. That survivor may now owe more in taxes on that $2,000 than they owed on the combined $3,500 before because of the new single filing status and how Social Security benefits are taxed. Up to 85% of Social Security can be taxable, and it gets triggered much faster for single filers. Retirement accounts add another layer of difficulty. Required minimum distributions, or RMDs, investment are mandatory withdrawals that the IRS requires you to take from traditional IRAs or 4-year one-secas after a certain age. When both spouses are alive, those withdrawals are often split between them, or at least absorbed more easily under the married tax brackets. When one spouse dies, the full balance of the retirement accounts usually rolls into the survivor's name. And now all of those RMDs are counted as that one person's income. This can catapult the surviving spouse into a much higher tax bracket, creating the perfect storm where income is dropping but taxes are rising. Healthcare costs also play into this penalty in a way many people do not expect. Medicare premiums, for example, are means tested, meaning the more income you report, the higher your premiums can become. So a widow or widower who is suddenly filing as a single individual may not only face higher income taxes, but also higher Medicare premiums simply because their taxable income looks larger under the single filer rules. It is a domino effect that very few people prepare for, and it is one that comes at a time when they are least able to deal with it emotionally or financially. The widow's tax penalty is essentially the government's way of saying, we recognize you as one financial unit while both of you are alive, but the moment one of you passes away, you lose that benefit. It can lead to tens of thousands of dollars in additional taxes over the course of retirement. And the cruel part is that it comes right when someone is dealing with grief and transition. Investment. Couples spend their lives planning for retirement, making sure they save enough, invest wisely, and live within their means. But if they fail to plan around this penalty, the surviving spouse can watch years of careful planning unravel in a matter of months. It is not a small problem, and it is not rare. It is one of the most common financial traps waiting for couples, and the only way to beat it is by knowing it exists before it strikes. ChatGPT said, when people think about taxes in retirement, they often imagine their income will be lower, their needs will be simpler, investment, and their tax bill will shrink accordingly. But the truth is far more complicated, and one of the biggest factors behind how much you pay isn't just how much money you make, it's how you file. Filing status is one of those hidden levers in the tax code that quietly shapes everything from your tax brackets to your deductions to the way Social Security is taxed. And when a spouse passes away, the shift in filing status can create a shock that most people are completely unprepared for. While both partners are alive, the married filing jointly status is one of the most powerful tools available to couples. Investment, it allows income to be stretched across wider brackets, meaning that the couple can earn more money before getting pushed into higher rates. For example, under joint filing, 20% and 22% tax brackets extend to nearly double the income levels of single filers, giving couples a much larger cushion. In addition, the standard deduction for joint filers is nearly twice that of single filers. These advantages combine to significantly lower the effective tax rate for married couples, even if their combined income is relatively high. Now imagine what happens the moment one spouse passes away. The surviving spouse is suddenly shifted into the single filer category. At first glance, that may not seem like such a big deal, but the numbers tell a different story. The brackets for single filers are compressed. Investment, meaning that it takes much less income to climb into higher tax percentages. The standard deduction is cut nearly in half. Certain thresholds that determine how much Social Security is taxed, or when additional Medicare premiums kick in, are lower as well. What this really means is that a widow or widower can be earning less income overall, but still face a higher tax bill. Investment, because the system no longer gives them the benefit of joint filing. Consider a couple with a $90,000 in annual retirement income from Social Security, pensions, and withdrawals. While filing jointly, a large portion of that income sits comfortably in the 12% and 22% brackets. After one spouse passes, the survivor may only see their income reduced to, say, a $65,000. On the surface, that looks like a drop, But because the standard deduction is smaller and the single brackets are narrower, much more of that income is now taxed at higher rates. In some cases, investment, the surviving spouse can find themselves bumped into the 24% bracket, paying thousands more in taxes on less income. The effect doesn't stop there. Social Security taxation is one of the biggest traps hidden inside this filing status change. For joint filers, the income threshold before up to 85% of Social Security benefits become taxable is higher. But for single filers, that threshold drops dramatically. A surviving spouse who was once shielded by the higher joint limits can suddenly find themselves paying taxes on the majority of their Social Security check. What once felt like a reliable foundation of retirement income can turn into a tax burden that eats away at their monthly budget. Then there are capital gains. For couples, the income level at which long-term capital gains are taxed at 0% is much higher than for singles. When the filing status changes, that cushion disappears, meaning a widow or widower who sells investments, then downsizes their home, or simply rebalances their portfolio may owe significantly more in capital gains taxes than they would have as part of a married couple. It is a hidden cost of losing the joint status that most people never see coming until the IRS bill arrives. And finally, filing status also influences Medicare premiums through IRMAA. The income-related monthly adjustment amount. These surcharges kick in when your income crosses certain thresholds, and once again, those thresholds are much lower for single filers than for married couples. Investment. A surviving spouse can see their Medicare costs increase just as their income and lifestyle are shrinking, all because of the way their income is measured under the single category. The truth is, a filing status changes everything because the tax code was built to treat married couples as a unit and to treat singles in a far less generous way. Losing a spouse does not just create emotional strain, it transforms the financial landscape in a way that magnifies the pain. It is not just about missing the other half of the income or losing a Social Security check investment. It is about suddenly being forced into a system that taxes you more aggressively on the money you do have left. Couples who don't prepare for this reality can find themselves blindsided, realizing too late that the shift in filing status has undone much of their careful retirement planning. ChatGPT said retirement accounts are often seen as the cornerstone of financial security in later years. Investment. But what many couples fail to realize is how dramatically these accounts can turn against the surviving spouse once required minimum distributions come into play. The government allows you to put money into tax, deferred accounts like traditional IRAs and 401(k)s for decades, letting it grow without paying taxes along the way. But eventually the bill comes due. Starting at a certain age, you are forced to begin taking withdrawals known as RMDs, whether you need the money or not. These withdrawals are fully taxable as ordinary income, and when both spouses are alive, they can often manage these distributions more effectively by splitting balances, taking advantage of the higher married filing jointly brackets, and spreading income across two lives. The moment one spouse passes, however, all of those strategies collapse into a single tax return. And that is where the shock begins. Think about a couple who has built up a combined $1 million in retirement accounts. While both are alive, they may be required to take out, say, $40,000 a year in R&Ds, but because they file jointly, that income is cushioned by wider brackets and a higher standard deduction. The surviving spouse, however, inherits those accounts and suddenly bears the responsibility of taking the full RMDs on their own. If the balances grow, those mandatory withdrawals only increase year after year, meaning the widow or widower is stuck reporting higher and higher income, but now under the much smaller single filer brackets. The result is that the very accounts meant to provide financial stability end up pushing them into higher tax rates and draining more money away in taxes and even causing ripple effects in other areas like Social Security taxation and Medicare premiums. What makes RMDs especially dangerous is that they are not optional. You cannot simply decide to skip them or withdraw less. The IRS enforces them with stiff penalties if you fail to comply, so the survivor has no choice but to take money out, even if they do not need it for living expenses. And because those withdrawals stack on top of any other income sources, pensions, Social Security, part-time work, they often push the surviving spouse into a much higher income category than they were in as part of a couple. This creates a frustrating paradox. Income may have dropped with the loss of a spouse, but taxable income and overall tax liability actually go up. Another overlooked piece of this puzzle is how RMDs interact with Social Security. For many widows or widowers, Investment. Social Security makes up a large portion of their income. The thresholds for taxing Social Security benefits are relatively low, and when large RMDs are added on top of that, it becomes almost impossible to avoid taxation on the majority of those benefits. So now, not only are the distributions taxed as ordinary income, but they also trigger higher taxation of Social Security, effectively creating a double penalty on money the survivor was counting on. There is also the long-term growth of retirement accounts to consider. If a couple has been diligent savers and those accounts continue to grow, that the RMDs do not remain flat. They increase every year. This means the widower may find themselves in an escalating tax situation at the exact stage of life when their spending needs are actually shrinking. And because tax brackets for singles are narrower, these increasing distributions can push them into much higher marginal tax rates far more quickly than they would have experienced while filing jointly. The compounding effect of all this is enormous. Higher taxable income from RMDs can not only increase federal income taxes, but can also lead to state taxes in certain areas, higher Medicare Part B and D premiums due to income thresholds, and even affect the net after-tax return on investments. The reality is that these required withdrawals do not just represent income. They trigger a chain reaction across the entire financial picture of the surviving spouse. Couples who fail to anticipate this shock may think they are secure because of the balances in their retirement accounts, only to discover that the IRS has positioned itself as one of their largest hares. ChatGPT said, "When it comes to the widow's tax penalty, the only real defense is offense." And that means taking steps while both spouses are still alive to minimize the financial hit that will come later. The tax code is written in such a way that the transition from married filing jointly to single filer almost always results in higher taxes for the survivor. But there are strategies that can dramatically soften the blow if they are implemented early. Everything makes a good investment. Proactive planning is not about avoiding taxes altogether, but about choosing when and how you pay them so that the surviving spouse does not end up facing a financial squeeze at the worst possible time. Investment. 3 of the most effective tools for this are trusts, Roth conversions, and life insurance, each playing a different role in reducing the widow's tax burden. Roth conversions are often the first strategy to consider because they directly address the problem of required minimum distributions. Traditional retirement accounts like IRAs and 401ks grow tax-deferred investment, which means taxes are postponed until money is withdrawn. That is a benefit while you are working, but it becomes a trap in retirement when those withdrawals are forced and taxed heavily. Converting part of those balances into a Roth IRA while both spouses are alive allows you to pay the taxes now, often at lower joint filing rates, and eliminate the need for taxable distributions later. For the surviving spouse, this is huge. Roth withdrawals are tax-free, and Roth IRAs do not have required minimum distributions during the owner's lifetime. That means less taxable income in the future, lower risk of Social Security benefits being taxed, and a lighter burden on Medicare premiums. The key is to take advantage of the so-called widow's window, the period when both spouses are alive, or the year of death when joint filing is still available, to execute conversions strategically before the brackets collapse into single filer territory. Trusts can also play an important role, particularly when the goal is to manage how assets are passed down and to control taxable income in the hands of the surviving spouse. By setting up the right kind of trust, a couple can ensure that assets are distributed in a way that minimizes the survivor's tax exposure. For example, certain trusts can be structured to split ownership of retirement accounts, real estate, investment, or investments in a way that provides income support without triggering large taxable events. Trusts also give couples the ability to lock in estate planning benefits and protect assets from being unnecessarily drained by taxes, probate costs, or even creditors. While trusts do not eliminate the widow's tax penalty, they create flexibility and control that can help spread income more evenly and keep the survivor from being hit with sudden spikes in taxable income. Life insurance is another powerful tool because it bypasses the tax system altogether. Proceeds from a life insurance policy are generally income tax-free, which means they can be used by the surviving spouse to offset the higher taxes they will face. Instead of having to take larger taxable withdrawals from retirement accounts, a widow or widower can rely on the life insurance payout to cover expenses, pay off debt, or even fund long-term care. In some cases, investment. Couples use permanent life insurance policies specifically as a hedge against the widow's tax penalty, treating it as a way to transfer wealth without the tax consequences that come with traditional retirement accounts. The beauty of this approach is its simplicity. At a time when everything else in the survivor's life feels uncertain, a tax-free lump sum can provide both financial stability and peace of mind. Investment, the combination of these strategies, Roth conversions, trusts, and life insurance, works best when tailored to each couple's situation. The common thread is that they all require foresight and deliberate action before the first spouse passes away. Everything until after the fact removes most of the options and leaves the survivor at the mercy of the tax code. Couples who take the time to plan in advance not only protect their financial future, but also spare their loved ones from the added burden of navigating complicated tax surprises on top of grief.